Most traders lose at the exact moment they feel the most confident. They see price tap a level, reject, tap it again, reject again, and instantly the mind labels it as strong support or strong resistance. Confidence builds. Entries become aggressive. Stop losses become predictable. But what if I told you those rejection wicks are not signs of strength? They are signs of preparation, and mastering them will save your money and keep you from becoming part of the sweep. Instead, you profit from it. In this video, we're going to break down one form of liquidity sweep and how to position yourself to avoid being taken out. Show your support by subscribing so you don't miss any of my videos, because one video might be exactly what you need to become a profitable trader. So stay with me. Let's break it down. When you see multiple rejection wicks at a level, what is the common interpretation? Buyers are defending support. Sellers are rejecting resistance. This level is holding. But in reality, that repeated reaction is doing something far more strategic. It is building liquidity. Every rejection wick attracts more traders. More buyers place stop losses below support. More sellers place stop losses above resistance. More breakout traders position themselves. What you're watching is not rejection. It is the collection of orders. Smart money is not fighting the level. They are using the level as a trap to gather liquidity. Price doesn't randomly respect a level multiple times. Each touch serves a purpose. First touch creates awareness. Second touch builds confidence. Third, and beyond, confirms belief. By the third or fourth rejection, the majority of traders are emotionally committed. That's when the trap is complete, because now liquidity is thick, and liquidity is fuel. When the sweep happens, it is usually fast, aggressive, emotional. Price suddenly breaks the level with strong displacement or a sharp wick. All those stop losses get triggered. This is the moment most traders get stopped out, not because they were wrong about the level, but because they misunderstood the intention behind the wicks. If you keep trading rejection wicks blindly, you will keep feeding the move. So shift your perspective. How? Stay with me. This is where it gets interesting. There are 4 ways. 1. Stop trusting repeated rejections. The more a level is tested, the weaker it becomes structurally, but stronger it becomes from a liquidity perspective. That's a warning, not confirmation. 2. Anticipate the sweep. When you see equal highs or equal lows forming multiple wicks rejecting the same level, tight consolidation near that level. Start expecting a liquidity grab, not a reversal. 3. Avoid predictable stop-loss placement. If your stop-loss is just below support, just above resistance, then you are placing it exactly where liquidity is engineered. Instead, stay out during the buildup. Let the sweep happen first. 4. Watch the reaction after the sweep. This is where the real opportunity is. After the level is broken, look for strong rejection back inside the range, displacement in the opposite direction, a shift in market structure. That's your confirmation that the sweep is complete. And this is just one form of liquidity behavior. There are even more deceptive patterns. So follow closely, because in the next breakdown, I'll show you a type of liquidity sweep that most traders never even notice, yet it moves the market just as powerfully.